Jason, thanks very much for the introduction. That was very kind. One small correction I should make is that I wasn't actually the CIO of the permanent fund. I was the deputy CIO, and I make that point because the actual CIO is out here in the audience somewhere, I think, and I don't want to start a fight. But I do appreciate you hosting this. Thanks to the governor's office for organizing this. We're grateful to have this chance to talk. Okay. I was thanking Jason, and I'll say that once more. Glad to be here. Thanks. So I'll start by introducing myself. I'm Steve Mosley. I now, as Jason said, work at Wafra, which is an investment firm in New York, where we manage about $33 billion in alternative assets, which means investments other than regular stocks and bonds. And our particular focus is on seeding new investment firms and investing in established investment firms. So we have a portfolio of about 27 different investment businesses, many of which you would have heard of, some of which you haven't. And it includes a couple that are focused on alternatives. The game plan here today for the group of us is that we're going to discuss some of the risks and the significant opportunities in the energy industry in Alaska. We're investors, so we never talk about opportunity without considering risk. We'll talk about some of the practical realities of the investment business, some of the constraints that exist as we plan around the different risk-reward considerations, asset allocation, and so on. And I think we'll be able to bring a little life to that topic by actually discussing some of the underlying investments that each of these investors and others have put together. So I'll just start by mentioning who's here, and then we'll turn to more thorough introductions. Starting on your right, Alex Bell is a partner at JP Morgan Asset Management. He's also pursuing now a fund focused on growth equity in climate-related areas. Next to Colin is Teresa Matamoros, who's the managing director at EQT Infrastructure. EQT might not be a firm you've heard of. If we were in Berlin now, you certainly would have heard of them. It's one of the largest investment firms in the world. They're publicly listed, and they were founded in Sweden. And knowing Teresa and many who work on the private equity side there, I would say that the sort of cultural flavor of Sweden is evident in the way they work, and we'll talk about the implications for climate. Colin Ledoux, great to have Colin here. He's one of the founders of Generation Asset Management, which is one of the largest ESG, for lack of a better term, ESG-focused investment firms out there. And sitting right next to me is Ali Al-Safar, who now works at the Rockefeller Foundation, and he'll describe for you some of the activity there. But interestingly also, Ali worked before that at the IEA, and I wasn't here for all of the panels today, but I'm 100% confident that in at least one of those panels, they would have mentioned the IEA World Book on Energy, which is kind of a go-to resource. And you'll see it in the footnotes at the bottom of most of the charts and most of the books that come your way. And Ali was actually the co-author of 6 or 7 versions of that energy book. So just to point out the obvious, I think it's not an exaggeration. In fact, it's a statement of fact that Ali actually wrote the book on energy. And we're here at an energy conference, so I'm grateful to have him. I think you'll each be better at describing your activities than I possibly could be. So let me ask you, if you could, and I'll start with you, Alex. Let me ask you to introduce yourself, just sort of a quick bio, and also describe your firm. In your case, JP Morgan, I think it'll be a familiar name, but it's so familiar, so global in every dimension. Describing your particular focus and activity would be terrific.
Sure, no, thanks, Steve. And look, I mean, for spirit of full disclosure, JP Morgan is a rather large firm. We are the biggest non-owned, state-owned bank in the world. And so as you can imagine, my view and my piece is a very small version of what the global firm is doing. So please take my comments as such. So what I'm focused in, and I've been in energy private equity for 20 years, doing oil and gas for most of that, and really in the last 5 and 6 years, helping now at JP Morgan, and before that at CDPQ, which is the second largest Canadian pension fund, lean into this transition. And so some of the things that the governor was saying really ring true to my ears in terms of, I've seen Clean Tech 1.0 about 18 years ago. I've seen Clean Tech 2.0, 7 years after that. And this time feels real. And being in conferences, talking to fellow investors who are leaning in, talking to governors, hearing from governors in his legislature that this time is real and that we're all kind of, all of the, referring to all the above and rowing the same way, is very, very encouraging, right? I joke that energy investors are not in the energy business. They're in the investment business. And so in as much as there are returns to be had, especially when you have in Alaska or any other kind of place support from the government and from regulators, you betcha that capital is gonna follow. But having said that, our strategy at JP Morgan in the Sustainable Growth Equity Fund is to lean into some of these themes, not so much on the supply side in terms of looking to fund solar farms or wind farms, but more looking at what we already have and trying to make it better. And so we're really leaning into energy efficiencies instead. So anything that we can do to be more efficient in sustainable food and agriculture, in transportation, in industrial decarbonizations. And the reason why we're doing this is, one, it's if you can save money by saving energy, and that's another theme that the government kind of talked about. Well, if we can do that, that means that it's going to be in and of itself a sustainable business, because it's a better proposition to go to someone and say, I'm going to save you energy, therefore I'm going to save you money, rather than let's invest in this for the sake of being green. So we're leaning into this with this green and not so much the other green.
Oh, thanks, Alex. I'm glad you made that point, that energy investors are investors. They're looking for return. And typically, each of us has a different strategy and category, and it's important to understand that. So maybe in that context, Teresa, I can ask you, please, to introduce yourself personally, talk a little bit about EQT, and then the specific bucket for which you share responsibility.
Sure, absolutely. First of all, thank you for having us here today, especially on the toughest spot of the day, which is right after the governor and before cocktail hour. So thank you. But Teresa Matamoros, like you mentioned, I'm a managing director at EQT. EQT is a purpose-driven global investment firm which focuses on active ownership. We have about $220 billion of assets under management. And we invest, I myself sit on the infrastructure fund that invests across different industries, transportation, logistics, digital, social, energy and environmental, and I particularly focus on energy and environmental. I spent the last decade focused on oil and gas and made the transition to EQT about a year ago, where I focus on our traditional oil and gas investments, but also on energy transition and decarbonization investment themes more broadly.
Oh, thanks, Teresa. And Colin, I'm guessing that Teresa's words about a mission-driven organization, purpose-driven investing would resonate with you. If you could tell us a little bit about your background and the mission that you're engaged with, the generation.
Yeah, sure. Thanks very much for having us. I appreciate being here, especially because I work for Al Gore. So, red states are always interesting places to come to. But I think just sort of backing up a little bit, Generation was founded in 2004 with a view to essentially focusing 100% on sustainable investing. And really our mission is to demonstrate that sustainable investing pays and that you can generate very good long-term returns in that context. So we are a boutique. We manage about $40 billion across public and private equity investments, about 120 people split between London and San Francisco. And essentially, there were 7 founders. The 2 famous ones are Al Gore and a guy called David Blood, who used to be the CEO of Goldman's asset management business. So we sort of, the Blood and Gore combination was actually a name we debated about whether to call the firm that. But we basically believe that sustainability is increasingly becoming the central organizing principle of the economy. And in particular, we invest around planetary health, so in particular around the climate solutions, investing, human health, and financial inclusion. Those are the 3 big themes that we invest behind. So we will invest in private companies, in projects, and in public companies. And essentially, we believe that there is an enormous investment opportunity for fiduciary investors of all shapes and sizes to invest in basically taking the amount of capital that needs to go into climate solutions from about $1 trillion today of climate finance to a year to $4 trillion a year to stabilize at 1.5 degrees C. So there's a scale issue, but there's also a speed issue, which is that capital needs to be deployed very, very quickly to close the impact gap to decarbonize the world, 50% in the next 7 years. So we have a real focus on trying to move and help our clients, our investors who are sovereign funds, large institutional investors of all shapes and sizes around the world, to basically deploy massive scale capital into deep decarbonization in particular. So there is not a shortage of money in the world with regards to the climate crisis. It's just in the wrong place, and it basically needs to be moved. So we can talk about some of the structural reasons and how you can accelerate that, but it is very notable to me listening to the conversation today how little discussion there's been around a disorderly transition risk. And there seems to be an assumption that there's going to be an orderly transition, which I think is dangerous. But thanks for having us.
Thanks, Colin. That's a disturbing note, but we'll return to those issues. Ali, let me ask you to introduce yourself. I think everybody knows the name Rockefeller, but not many people understand the purpose of the Rockefeller Foundation. And from there, we can maybe dig a little further into your background.
Thank you very much. And yeah, I'm delighted to be here today to be with you all. The Rockefeller Foundation, I work on the Power and Climate team of the Rockefeller Foundation. Our main remit is basically to put out philanthropic financing for energy transitions and energy access projects. So our largest investment in 110-year history was in the creation of something called the Global Energy Alliance for People and Planet, which was launched in COP26 in Glasgow a couple of years ago. And this amounts to about $1.5 billion, and it's focused mostly on low and middle income countries to try to boost the energy transition, but at the kind of forefront of it to bring affordable and reliable energy to underserved communities. Now, obviously, there's a corollary there to what's happening in Alaska, but I also wanted to mention something from my previous role that you mentioned at the International Energy Agency, which is also, I think, has parallels to some of the challenges you guys have over here in Alaska, which is the issue of navigating an energy transition when you're an oil and gas producer. And so for the last 5 years at the International Energy Agency, I spent 11 years in total, but what I was in charge of doing over there was running a program to work with oil and gas producing states to see whether there are clear pathways or pathways to mitigate some of the risks to them. In other words, if oil and gas makes up 80–90% of your fiscal revenue, as it often does in some of the oil and gas producers, the energy transition then isn't just about navigating one part of a system or one part of your economy. It becomes something that's existential. And so some of the projects that we were working on was working with countries that are very dependent on oil and gas to see if there's ways that you can have kind of transversal opportunities. In other words, are there areas of competitive advantage today that exist in your current industry that you can put towards the energy transition that keeps you at the forefront of the clean energy sector? And we found that there were a lot, and I'd be happy to speak about that a little bit later on. And so, this is basically the crux of my work right now, investing from a philanthropic lens in energy transitions and energy access projects, but also looking at kind of the broader risks of an energy transition, especially, as Colin just mentioned, of a disorderly transition. Because essentially that's what we're seeing now. A lot of people, when they speak about the energy transition, they say, you know, they look at it from the supply side. Do we have to shut in supply, etc.? When we do the modeling when we used to do the modeling at the International Energy Agency, you forget the supply side until you've managed the demand side. You look at what happens to demand, then you try to match supply to demand. But when you have a situation where the price of the commodity is no longer enough by itself to incentivize an investment, then you get these kind of dislocations, which basically throw supply and demand out of balance, does all sorts of crazy things to the volatility of oil prices, which makes managing the economy, if you're dependent on that much harder. So that's kind of the lens at which I look at some of these challenges.
Oh, thanks. That's terrific. I mentioned that I work at a firm called Wafra. What I failed to mention is that we're wholly owned by the Kuwaiti social security system. So naturally, I go to Kuwait and to the region fairly often. I've spent a lot of time there, and I will say that the degree of dependence on the oil industry is well known. The effort to change varies from country to country, and the degree of urgency varies, but there are without question useful economic models and practical experiences that good outcomes and bad outcomes from which I think we can learn. So Ali, I'd like not to defer. I'd rather not wait to hear some of the projects and possibilities that you've observed in that region over time and their applicability to Alaska. For example, what can we do with gas while it's still in the state? Are there industrial expansion considerations and so on?
Yeah, thanks a lot. The challenges are pretty much clear at this point. Effectively, when you have a volatile commodity price and the bulk of your fiscal revenue is based on that, then what tends to happen is that you have these spending cycles in which when oil prices or gas prices are high, you get these big spikes in expenditure, but when oil prices and gas prices are low, then you start to get cuts to budgets. This is a typical kind of pro-cyclical fiscal policy issue, and that's been really problematic for a lot of oil and gas states the world over. I was looking into the statistics, and there's studies basically saying that for every 10 percentage point increase in the proportion of oil in total exports, the long-term per capita GDP declines about 7%, because it just throws up all sorts of management issues, like management of resource issues that do funky things to long-term economic growth. And so the idea is, and when I was looking into kind of what's happening in Alaska, I noticed that in the budget you have basically an oil price of $68 going up to 2030. You have quite high reliance on oil and gas revenue in total revenue. So I mean, some clear analogies there. The kind of go-to area and the thing that we would advise oil and gas countries that are not Alaska, that are starting off from a slightly different base, is to find whether there's areas where you have competitive advantage today that you could add additional value. I mean, why export why export a primary product? That loses value over time. Is there ways to add additional value in state, then export that heavy, that kind of highly energy intensive finished product? We've heard over the course of the last 2 days that Alaska has some of the best environmental standards in the world. If there's a premium for products like this, if there are carbon border adjustment mechanisms that put a premium on finished products like steel or any other heavy, highly energy intensive product, then what can be done in state to try to capture some of that additional value now? I think, in a sense, maybe you're thinking a little bit too small if you're thinking about only exporting the primary commodity. And by doing so, by adding that additional value, you're kind of also mitigating against the effects of the volatility in the price of the primary commodity as well.
Got it. I heard somebody compare that to economic development in Southeast Asia over the years, and pointed out that you don't want to be a rubber exporter forever. That's not our commodity, but it didn't turn out well for Malaysia. Colin, if I could turn back to you, you made an interesting point, I think, when you said that there's not a shortage of capital. I think you're referring to financial capital in the world, but rather the wrong kind in the wrong place, or what are the in the context of those limitations? I'd be interested in hearing how Generation invests across what investment people would call asset classes or categories with known risk and return characteristics. How do you approach that at Generation, Colin?
Sure. Yeah. So I think it's the old adage that people do what you pay them to do. So I think incentives in the investment business drive all behavior. So one of the reasons why there are certain parts of the climate solutions landscape where it's very well funded, so let's just take renewable energy development in North America, there's plenty of capital for that. The problem is that there's not enough capital for all the other things you need to do in the entire global economy to stabilize the climate. And that's because we as investors are not typically incentivized to maximize impact. We're incentivized just to manage for a financial goal. And so I think there's an increasing realization, and a lot of the greenwashing pushback and the ESG pushback that's out there today is reflective of this, is that the equation's not adding up in terms of societal outcomes. So sustainable investing, long-term investing, ESG investing, whether you love or loathe that framing, has basically demonstrated that if in a long-term investing context, if you take a wider set of issues into consideration, you're going to manage risk and return better than if you don't. So that side of the equation is now well accepted. The problem is that we're going to miss every single one of the 17 Sustainable Development Goals by a country mile, every single one of them, the worst one being climate. So the impact side of the investment community's integration of some of this long-term thinking is not adding up. And that's because we're not paid to deliver impact, we're paid to deliver financial returns. And those two things don't always go hand in hand. And that has basically meant that just in the context of our firm, we are innovating around the objective of investing, that we also want to help sovereigns or public pension funds deliver a healthy society for their members, not just deliver financial returns. Because the cost of living in a 1.5 degree world is going to be way cheaper than a 3 degree world. At the moment, we're heading for a 3 to 4 degree world. So the liabilities on a pension go up a lot, and therefore the return requirements go up a lot if we continue to carbonize the world the way we are. So the way we think about that at Generation is we have an incentive scheme that basically allows us to only get paid if we reach certain impact goals. So this is called impact-adjusted carry, where effectively in the private equity businesses of Generation, we will only take carry, which is basically the share of profits that we make for our clients, if we hit specific decarbonization goals in terms of absolute greenhouse gas reduction targets. Now, some people, this is not a political statement in any way, this is just an economic reality that a lot of our clients who are sovereigns or systemic investors really, really, really care about decarbonization. And they don't want to just invest in a kind of climate fund that's not really decarbonizing at the scale and pace required. So we basically believe that you have to change the incentive scheme for the asset manager to be able to help asset owners deliver on their net zero goals. And if you don't do that, money will not go into green steel, money will not go into upgrading grids in emerging markets, money will not go into stopping deforestation. It will just continue to flow into easy investments, right? So it's really about the incentive scheme that you need to innovate on.
Can I just add something? I
Please.
think it's relevant. We're also doing it on the financing side, and what I mean by this, we are leaning more to having ESG financing, linked financing at our portfolio companies. And what that means is that unless the company meets certain goals, environmental goals and social goals, reduction of greenhouse emissions, more recycling, more diversity at the board, unless they meet certain goals by certain timelines, their cost of capital actually goes up. So we're also seeing the incentive on the financing and the cost of capital level, just to add to that point.
Could I just add one quick thing to that? I think that's fantastic because we've certainly, and I'm sure you guys are doing it as well, we feel very close to EQT's philosophy as well, is that we look for the credibility of a transition plan sticking to a 1.5 degree science-based target. Okay, there has been a lot of backsliding from a lot of companies, a lot of states, a lot of investors since Ukraine, where basically they were at Glasgow COP saying we're committed to net zero 1.5, and now they're suddenly saying we're not committed to that. So it is very interesting that the cost of capital goes up, right, if you're not truly committed to transformational climate action. You know, as the UN Secretary General said the other day, you know, with climate solutions, we need everything everywhere all at once. So we need everything, but we need to commit to a science-based 1.5 degree pathway. So you need to ask yourself, does your business plan fit with that? And we as capital providers and investors, we are not going to back companies that are not aligned with that. Because we think the risk is inherent, that they're just exposed to transition risk if they're not on a proper pathway.
And just to this, not to make it a dialogue, but just to clarify, we also we have the goal of having every single portfolio company having science-based targets validated by 2030. We already have about 20% of our companies that have. EQT, the parent company, was the first investment firm to do it back in 2021, but we also want all of our portfolio companies to do it as well, in addition to the ESG financing.
It's super interesting. I'm going to come to you, Alex, in just a minute, but it is part of almost every conversation in global investing these days, this question of the tension, or whether indeed there is tension between climate goals and investment goals, and the integration of those two important dimensions continue to be a challenge. So it's interesting to hear how you're approaching that at EQT and Generation. Alex, what about your world at JP Morgan?
Yeah, a couple points on that, and I think totally agree with my co-panelists have said. I think part of what, and the reason why in sustainable growth equity inside of JP Morgan, where we're leaning in is precisely where you can have both, and where you can make outsized returns compared to infra, because there's a lot of, as Colin mentioned, there's a lot of capital already that's a developed market on the supply side. And so by leaning into younger companies, call it, 25 to $50 million companies, we call it the magic middle, where we're investing in companies that don't have technology risk, but they do have scale-up risk. You don't have enough kind of capital going through there. You're able to, one, hit the returns, and more importantly, and which is my second point, and I'd be curious to see how you guys do this, is this conversation is really irrelevant unless you can measure it, unless you have third-party measurement mechanisms where, one, you're drawing the line, right? There's a fund in my previous life where I worked, we had a very similar carry structure, right? But then a lot of the pushback that we get from investors is like, well, but who's doing the measurements for you, right? And so none of this works unless you have a good measurement kind of scheme that is agreed upon with your investors and whether they're state players. And I mean, frankly, what we've done at JP Morgan and the sustainable growth equity is that we've invested millions of dollars to have a platform that we call Clarity, where not only are we measuring this to the point of Article 9, because that's our strategy falls in that, But also it's doubly verified by PwC and KPMG that can come in on an annual basis and make sure that what we're saying, what we're measuring is true. And more importantly, and hence the name, we're giving access to all those metrics. Name the ESG metric, not only just greenhouse gas emissions, but also diversity, everything around those metrics. We're giving that information from our portfolio companies directly to our investors on a real-time basis. And so if we're overly transparent and we can measure things and someone can verify it, we think that we'll be rowing the same way here.
Got it. Yeah, the measurement's important because on Wall Street, nobody trusts other people on Wall Street. You need third parties to look at these numbers and determine whether they're right. My experience was always that everybody I met was in the top 10% of their category, and that would be true even if you had 100% of the population. So you don't need to be a statistician to see that there's some problems there. So Alex, if I could just turn a little bit, I don't want to unnecessarily politicize this, but I'd be interested, given your platform at JP Morgan, given the scope of activity and its presence everywhere. I mean, I don't think it is an overstatement to say that commerce relies on JP Morgan. I'd be interested in your thinking on this question that surfaced here in the state around divestment or continued support of investment in conventional energy infrastructure, particularly in the Arctic.
So you don't mean to put me in the spot, but here I am. Let me try. Look,
You literally have a spotlight on you and a microphone, but
we are the biggest non-state-owned bank in the world. So we will have exposure, and we will support companies both and we are supporting companies both in the traditional as well as the renewable energy. And so, yeah, we are one of the biggest investors and financiers of traditional energy, but we're also one of the biggest financiers of, and this is not my strategy, but like more on a global basis, of renewables as well. Now, what's exciting, and I don't think anyone in JP Morgan would say that we can move forward by divesting. We think we move forward by engaging. And so how do we do that, right? One of the big commitments that we've announced, so we're investing and we're helping finance 2.5 trillion, that's with a T, in energy transition assets here in the next 10 years. That's a big slug, right? And so for us, a lot of our companies, when they come for financing, we've gotten to the point where it's like we're not only providing capital, but we're also providing them help for them to measure their own scope 1, scope 2, scope 3 emissions, and to help them move that way.
Got it. I noted the governor's comment earlier about valuing input from investors on why they're investing in the state, what they could be investing in the state, and what are the obstacles. And I think it would bring this conversation to life to an even greater degree if we could talk about specific investment portfolio companies or themes of interest. So, Colin, maybe I can start with you. I'm aware of at least one Swedish battery business that sounds relevant, but I'll leave it to you to choose what you think might have relevance to this economy.
Well, I think, the first thing to say is that I think Alaska offers incredible opportunity for global investors. So I think it's fantastic you're doing this. I think it's fantastic the governor's going to be in Berlin at Super Return. I think there's so much about this state that is fantastic from an investor perspective. Back in the day, I did a project for BP in Anchorage 20 years ago. So, I have some affinity for Alaska. But anyway, what I would say is that, however, you compete with every other geography in the world for capital. So I think that's the thing. For us, sitting in, a fancy office in the middle of London, we can kind of choose where we go with the capital. We have global investment mandates. So that means we're going to compete geographies against each other when we look at the attractiveness of different regions. So I think when it comes to some of the more infrastructure end of the spectrum, I think you're looking for, you know, long-term policy certainty around deep commitments to climate, transformational climate action, and you're looking for long-term support for whatever it is this company's doing. So you asked us to bring this to life. You probably know this company very well, but H2 Green Steel is a very high-profile project in northern Sweden, which is not in the battery space, it's in the green steel space, which is basically taking steel emissions to zero by building from scratch a 4 billion euro steel plant in the Arctic Circle in Sweden. And so what they're doing there is they're basically building an entire town, you know, around this new steel plant that's going to be fully renewable powered, hydrogen enabled, electrolyzer enabled technology that basically delivers zero carbon steel to the market. So this is an example of transformational climate investing versus incremental climate investing, where there's a lot of money going into making dirty steel slightly less dirty, which is an important thing to do, but it's still dirty steel, right? So our investment thesis is essentially that assets that truly decarbonize the economy, i.e. remove emissions from the system, rather than just emit slightly less emissions, are actually going to be worth more because the supply of things like green steel or sustainable aviation fuel or whatever it is way lower than the demand for it is. And so in the H2 Green Steel example, they have already sold 60% of the offtake forward, even though they haven't even built the plant yet, at 25% premium to the commodity cost of steel. Because the car companies want true zero emissions steel. They don't want just slightly less dirty steel. They want clean, 100% zero carbon steel. So that is an example where the Swedish government provided a lot of support and a lot of reassurance that, you know, the energy would be available for this plant, that they would support the build out of effectively a new town. They would support the reskilling of workforce from the mining industry to now become operators of steel plants, et cetera, et cetera, et cetera. And then, of course, a lot of the local investors got involved, and Generation got involved as well. But this is a massive project that is very atypical. You know, there's not a lot of people who would fund a 4 billion euro industrial startup, right? It's much easier to fund a software company in California than it is to fund a steel plant building from scratch, right? So that's just one example. And I think Alaska is very well set for being a testing ground for cold, clean technology in particular. Because a lot of people want to test that kind of technology. Obviously, data centers, I've talked about steel, you've talked about ammonia export, you've talked about the hydrogen, you know, kind of export opportunity with regards to Asia in particular. All of these things are fantastic opportunities for Alaska.
And Teresa, Stockholm is almost the same latitude as Juneau, Alaska, where I lived for 9 years, and obviously northern Sweden is another Arctic nation. I'd be interested in EQT's perspective and your experience. What's a deal? What's an investment that you think might have some relevance to the Alaskan landscape?
Yeah, as I think through, we're thematic investors, so we pick big themes that have good secular growth trends behind it, and find companies that are market leaders where we think we can drive change and create value. In the energy transition space, some of the themes, just to give you practical examples, that we've been deploying capital, obviously the scale up of renewables, that's a logical one. We've been deploying capital in solar, both at utility scale, but also community scale. I think in Alaska, there could be some opportunities in that space. We spend a lot of time on brown to green, in particular in transportation. And what I mean by this is that we acquire companies that have, I'll give you a couple of examples, a school bus company in North America, the largest school bus company. We have 45,000 buses, transport 90 million students a year. And what we've done is bought the largest company and used that scale to leverage a transition. And by start electrifying the fleet in the company, we think will be able to drive change across the continent. That company actually has a presence in Canada. You will be doing that, sorry, not in Canada, in Canada too, but in Alaska, and we'll be doing that here. Those are some of the themes we've been exploring. Also electrification, been spending a lot of time in ports and just electrifying the transportation around ports. California has very supportive legislation, so we've been spending a lot of time on that. Building electric infrastructure in hydrogen fueling infrastructure for long-haul transportation is another space where we're deploying a lot of capital. So these are all themes that we've been exploring.
I think you'll hear there's some interesting programs and schemes in place that will align with what you're describing. I'm actually a little surprised to hear you say California and supportive legislation, but happy to share the coast with them. Alex, tell us about the deal you've worked on.
Yeah, this is just real quick, because I know we're bottom of the hour here, but our approach is a little bit different in terms, like I mentioned earlier, instead of building assets, we're really investing in companies that can help efficiencies. And so very particular to Alaska, we have a company called MineSense, and I think we're going to meet with mining executives hereafter. But this is a company that creates and deploys sensors that go into the bucket of rare earth and copper mining operations that allows the miner to immediately, at the mine wall, figure out the yields of whatever they're excavating. And so rather than taking that bucket of aggregate, crushing it, putting it downstream, spending not only a bunch of money, but also a lot of emissions before they know what they have at the end, you can do that immediately and thereby not only increase yields, which is really hard to do in the mining business, decrease costs, and save massive emissions. And so, one of the most exciting things that I heard from the governor speak in terms of Alaska being able to be and really lean into the energy transition and around minerals for batteries and the energy transition, I think that's a good example of how one of our smaller companies can help that transition and can help the state and mining companies here.
Oh, that's super interesting. So it's actually a device, MineSense manufactures a device that resides in the bucket of the.
Yeah, and with a little bit of software in California. So.
I bet. I bet. Okay, thanks. Well, I think we have just enough time left to thank the governor for organizing this conference and his staff and volunteers and others. It's been wonderful. And thank these terrific panelists for sharing their insights on their businesses and on Alaska. Thank you very much.